started. Recording now. Yeah, 3 attendees, 3 people on already. All rise.
There he is.
Right.
What's going on?
All right, man. Good to see you.
Who's your list of attendees?
I was actually in downtown Mesa today.
Their numbers are down.
Touring investors for your opportunities.
The count.
That's what I want to hear. That's what I want to hear.
Everything, and then just make sure if you go over here.
How'd that go? That was Scott.
Over here.
Was that with Scott?
That was with Scott.
Cool.
Yeah.
Yeah, Ted.
Alrighty.
Working on opportunities.
Good afternoon. We're going to get started in just a moment. Folks are getting settled, so go ahead and log on, sit down, and we'll be with you in just a moment.
Chris, this pops up. That's the extra speaker. Did you want those? Yeah.
Sound of the other panels.
Well, thank you everybody for joining us today for this webinar about Opportunity Fund projects, what it takes to get deals done. My name is Shawn Neidorf. I'm from the Arizona Commerce Authority and I'll be moderating today. I want to start by just going over a few rules and procedures for the call so that we can get started. Let me just get over to my PowerPoint here. I'm going to introduce the panelists in a moment, but I wanted to just start by pointing out that if you want to submit questions to the panelists, there's a Q&A button on the webinar. It's on the in the web window, and that'll open a window for you where you can enter your questions, and please type them in and submit send, and we will pose them to our panelists. Now, I'm sure many of you have seen this map many times. It's our Arizona Opportunity Zones map. I have found that when I'm showing this map in rural areas, the first question is, why are there so many tracks in urban areas? When I show it in urban areas, the first question is, why is so much of the Opportunity Zone territory in rural? In every case, it's one census tract, which is about 4,000 people. In an urban area, that's a tight little square rectangle. In a rural area, it's a much larger, much more abstract arc kind of shape. I also wanted to share with you a tool that we have that you can use anytime, 24 hours a day, and that's the Arizona Opportunity Zones Network. This is an online tool where you can search for experts, you can search for funds, you can search for projects and properties that you can invest in opportunity zones. You can also post your own experience, expertise, funds, or projects. This is linkable, which obviously isn't going to help you very much right now, but we'll make this available online. And frankly, if you just go in and Google Arizona Opportunity Zones Network, you will have no problem finding that. So I want to tell you a little bit about who's going to be joining us today. We have Steve Ayers, who's the Economic Development Director in Camp Verde. We have William Jabjiniak, who serves in that role in Mesa. We have Loeffler and Brion Crum from Caliber, one of our local funds. We expect to be joined very shortly by Michael Lafferty from Lafferty Development, who's also operating a fund, as well as Oliver Schwab from Virtua, again, another local fund manager. And we also have with us Jonathan Tower, who's actually from a firm called Arctaris in Boston, but they are looking at Arizona investments and also doing some interesting work around operating businesses. So we wanted to make sure that we heard from Jonathan as well. So I'm going to start by asking various members of our panel to introduce themselves a little more fully and give us about 5 minutes about what they're doing with opportunity funds and opportunity zones. Brian and Chris, can I ask you guys to kick us off?
Brian, why don't you go first? So at Caliber Company, we're excited that we've been one of the very first opportunity fund sponsors in the country. So it's been really interesting to see how everything has taken shape and where we've come in a very quick 18 months. And we're sitting here with our CEO and co-founder, Chris Loeffler, who probably has seen more deals than just about anyone in the country at this point.
Yeah, it's been, you know, in terms of looking through the topics for today and what makes a project attractive, et cetera, hopefully we can bring a lot to the table. Brian has done a great job helping us stay engaged with various communities that we're working with. And you know, from a background perspective, Caliber is now, we've got a $500 million offering in the fund. We're looking to do about $1 billion worth of projects in the next, call it 5 years. And so far we're off to a good start. We've got the first 100 million of projects in the works, and a large portion of them happen to be in Bill's home backyard. So we're looking forward to talking about those.
Sounds like fun.
Oliver, can you introduce yourself and tell us what Virtua is working on? Yes, he told me he was on. Okay, Oliver? Okay, we'll come back to Oliver because we're having a little bit of trouble there. Steve, can you tell us about what's going on in Camp Verde?
Sure. My name's Steve Ayers. I'm the Economic Development Director here in Camp Verde. We have currently 4 projects that are Opportunity Zone projects underway, 3 by one investor and 1 by another investor. They are all single investor opportunity funds. So they've been able to move rather quickly. One of them is a 400 and some unit RV park, which is complete and in business. There's also an 80-acre business park. There is a 175 acre, 600 unit home development, and most recently a 6-acre small technology-based business park, which is was purchased about 2 weeks ago. Actually, they're finishing up escrow on it, and that will include 2 light manufacturing facilities initially on that property.
Okay. Bill, can you tell us about what's going on in Mesa?
Sure. We have 2 hours. I should be able to fill that in for you. So along the way, but Bill Jabjiniak, Economic Development Director, City of Mesa. As some of you may know, Mesa is a fairly large city with about 140 square miles. We have 11 census tracts that are identified as opportunity zones, really divided into 4 regions of the city. We're seeing activity in all 4 of those regions, which is, I think, fantastic. Downtown, as Chris talked about, is really bringing a mix of uses from office and retail, and I think there'll be some residential in play. There's another downtown housing development that has utilized the fund up in the Falcon Field area up around. We have 2 airports, and both of those, I'm glad to report, are in opportunity zones. So we're seeing a mixed use development that's approximately 40% funded with opportunity zones, which I think is fantastic, up around Longbow in Falcon Field. And we're also seeing a lot of interest now and some activity with funds on industrial down in the Gateway area. So we've seen a lot of investment over the last year and a half, 2 years, and now we're starting to see more of that being funded through opportunity zones.
Okay, thank you. And Jonathan, can you talk to us about Arctaris?
Sure. Hi, good afternoon. Jonathan Tower. I co-founded Arctaris 10 years ago. I'm also from Arizona originally, but live in Boston. Our firm is based in Boston. We started investing in what we commonly call opportunity zones 10 years ago, low-income census tracts throughout the United States. Before the OZ legislation, we had done 4 funds, which were partnerships with cities, states, and county economic development agencies and a wide range of foundations to invest in companies and infrastructure projects that can create lots of quality jobs. We partnered with U.S. Treasury Department back in 2014 to do a Pure Michigan fund, and then partnered with multiple state economic development agencies in 2018 to do a much larger $500 million program to invest in companies throughout the United States. With opportunity zones now, we view this really as a power tool that's stronger and more useful than anything that we had before. And we've launched, we're targeting $500 to $750 million on this next fund. It's a principal protected fund, meaning that we have first loss capital or guarantee commitments from a wide range of government partners and foundations. And then the fund itself is investing in industrial and manufacturing businesses, really by definition, companies that can create 50 to 200 jobs, and then also infrastructure projects, pretty wide range in the definition of infrastructure, but that's going to be rural broadband infrastructure, fiber, towers, switches. We do a lot of solar farm, municipal scale solar farm. For whatever reason, we're doing quite a few projects right now with universities and smaller municipalities that have water needs, wastewater treatment facilities, water pipes, things like that, and you know, kind of everything in between. So I think you could view us as a traditional private equity investor on the business side, and then on the infrastructure side, we're doing a lot of things that you'd normally think of as municipal public works types of projects. Typical investments would be between $10 and $50 million, and you know, we work very closely with the portfolio companies and the projects to help ensure their success.
Thank you. Oliver, can you talk to us about Virtua?
Wonderful, Sean. Thanks so much, and this is a great call. I'm excited to hear how many other funds are partnering with foundations. My background was as a staffer on the U.S. House Ways and Means Committee for an Arizona member, helping support the drafting process of this opportunity zone language. So I was pretty excited to see Virtua take on the first projects and the first funds in the country. Being a very tax-centric firm, we've really worked with government partners to define both the compliance and regulatory landscape when it comes to the metrics for jobs, housing, really in the spirit that that if this program is going to work, it needs to work in the context of a 10-year hold. So you need to have a different strategic approach to how these assets are going to be managed. And then they really need to accomplish three things. They don't need to accomplish all at all times, but they should be spirited to accomplish the following three, which is entrepreneurship, job creation, and reducing crime. And so we really focus in our portfolio on housing and hospitality. Housing being safe communities where we're partnering with foundations and partnering with municipalities on what local needs are. And that's really been the most exciting thing. And I would presume that the other funds on this call would share a similar spirit. This has really been the most exciting thing about this legislative language. Opportunity zones are not a solution unto themselves, but they start a conversation with stakeholders, particularly the community, and they bring investors into opportunities that they otherwise might have passed on. And as I'm sure the other funds on this call have started to see, is that by partnering with nonprofits, we can actually accelerate the tax treatment in such a way that you can take on even more important projects for communities. So Sean, thank you for convening this. This is a great group, and I particularly love what all of us are doing in the Sun Belt right now. I mean, we are helping Arizona's growth in a really, really substantial way. So thank you, Sean.
Well, thank you very much. We're still expecting one more person to join us, but we're going to go ahead and get started. I should say we were expecting one other, which is Patrick Quigley from Chicanos Por La Causa, which I know many of you have worked with. Unfortunately, he is taken ill, so I said, you should stay where you are.
Yeah.
Thank you. No, thank you. So he unfortunately was not able to join us. So I will ask those of you who've worked with CPLC or LISC or any of our other organizations, if you would kind of highlight those things in Patrick's absence to kind of cover that. And I have some questions in there that I will ask to make that work. So what I'd like to do is
Sean, this is Oliver at Virtua. Because of the work that we've done to partner with Patrick and CPLC, if there's anything that you want me to speak to on that angle, I am happy to. Just as an offer, we partner day in, day out on pretty much everything OZ related.
Excellent. Well, I will keep that in mind. It's going to be a little hard since this is predominantly a call for people to know who's speaking. So I will ask you to say this is Brian, or this is Oliver, or this is Jonathan when you start, just so that people on the phone know. And if I think about it, I'm going to try to hover on this list around people's names so they'll know, oh, this is Steve, or this is Oliver. I don't know if I'll remember that every time, but I'll try. It's a little low tech, but I'm hoping it will work. So I want to start out with a question for the fund sponsors, and that is, what makes a project attractive to your fund? And what makes you walk away?
Awesome. This is Chris. I'll kick it off. You know, I think the first and foremost for me that makes the project attractive is did the person bringing the project to me or the group bringing the project to me think through what are the implications of an opportunity zone investment in this project? As an example, we're a real estate focused fund. So if we're looking at a real estate project whereby, you know, there's a good opportunity for a decent cash flow on the investment, but, you know, there's very little appreciation involved or no appreciation, then it doesn't really fit the parameters of what's required for an opportunity zone, because the most important tax benefit in the program is not paying taxes on the future growth of the value of the investment. So we look for projects where the person bringing us the project has thought through how, not only how it's a good project in general and how it's going to be a profitable project for us as an investor, but also how that intertwines into the requirements of an opportunity zone investment. You know, and how do we find that? I mean, it's really simple. We look for some sort of strategic advantage that allows us to acquire the property for a discount to its inherent value. Maybe it's construction value, build value, or comparable market value. We look to develop the property, build it, or renovate it or redesign it in a way that allows us to build value into the property over time. And we hope that at the end of that entire experience, we're going to achieve a 10% or better cap rate on our basis. And so that usually creates enough upside potential that when we do sell, we're going to have a nice return on our capital. And it doesn't really matter to us whether it's going to be an apartment complex, a hotel, a retail building, or anything else in the scheme of real estate. We have a very similar underwriting box to that. And I think one thing I'll just add to that is there's in opportunity zones, there's a lot of impactful community projects we can do. And I think there's a kind of a fallacy or a thought that, well, if it's going to heavily impact the community in a positive way, it's not going to be able to achieve these types of parameters and create a profit for the investors. And at least from what we've seen from the projects we've worked on so far, that's not the case at all. We're hitting our numbers and we're still creating a significant community impact in the different projects that we're doing. So hopefully that helps on my side.
Sure. Jonathan, can I ask you what makes a project attractive to your fund and what makes you walk away?
Sure, and it's a great question. Obviously, the answers are pretty different for operating businesses versus infrastructure. But for an operating business, we're looking for a strong, qualified management team. We certainly see situations where people have 20 years of experience doing exactly what they're doing, and they want to grow, and they have a well thought out strategy for doing that. We also sometimes see great ideas that lack the management team, and that can be a real challenge for us. In some of those situations, we can bring in the right management team to take that company or the opportunity to the next level, but it's a much longer push for us to be able to get something like that over the finish line. Typically, on the financial side, we're looking for companies with 5 million on up of EBITDA, trailing EBITDA. We do loans, small business loans for companies that are below that hurdle, but you'll typically see $5 to $15 million of trailing EBITDA in a company that we would want to invest in. And then also just in compliance with the opportunity zone regulations, if we're buying a company for $25 million, we need to put another $25 million into fixing it up. The question sometimes becomes, well, how are we going to do that? Buying 2 hammers when you only needed 1 might not be the best and most efficient use of capital. Just as an example, we're working on a company right now. It's a rural company. We're buying it. 5 million in trailing EBITDA. When you consider the price that we're paying to buy it, we're not going to be able to double that in terms of CapEx or regular spending to get to the substantial improvements test. But we looked more holistically at how that company fits into the community where it's located. And although that census tract happens to be both OZ and severely distressed, it's halfway between 2 pretty wealthy areas, and they've kind of gotten the gentrification wave on both sides. So employees of this company are earning a living wage already. but they can't afford to live in the town where they're located. So the solution there is to actually add workforce housing adjacent to the business so that people can get to and from work without a car and have more of a cluster, an ecosystem, a real community there. We're filling our substantial improvements test by putting $10 million into affordable housing. And just kind of getting to the bigger picture here, these are the starts of ecosystems. You have a company, you have workforce housing, we can add solar, things like that. If it's a manufacturing company, the manufacturing building around it, that might wind up being 4 deals in one, but the company is stronger because we can attract and retain better employees. They're going to save money on their utility bills because we own the solar. They're going to save money on rent because we own the actual physical property. So all of these things work together. There's a lot less friction and fewer middlemen in the middle of the transaction. We really like things like that where we can pull together 3, 4, 5 different transactions into one and create a healthy ecosystem. These are harder to find, but we do seem to find them in both inner cities and targeted rural areas pretty frequently.
Oliver, did you want to tackle this one?
Absolutely. I think that one of the common themes that we've just heard is that demographics matter. And there's really important context for that. And that is the fact that to satisfy the compliance in the tax structuring, any asset acquired with OZ funds, you really need to think about it as a generational hold. This is going to be 10 years, but it also might be longer because unlike other assets which managers may take on, the most important thing is to maintain this asset's performance on the best day of the economy in the next decade and the worst day in the economy in the next decade. And so you have to be really thoughtful about what kind of an asset you're taking on and not over leveraging and making sure that the demographics support the ecosystems, just as we were discussing. Some of that is going to be by drivers around that asset. But other times you're going to be working with, and this is really where the beauty of an organization like CPLC or the Urban League or so many of the other wonderful foundations that are comfortable taking on development projects can bring to a partnership in this market, in this new asset class. This is really a brand new asset class. Treasury will still be coming out with guidance for years to come on opportunity zones, very akin to what they did with 1031s. And so the SEC is going to be working with all of us in a very proactive way to make sure that in terms of fund structure, the support is as it should be, but also in terms of the deployment of capital. So this is why housing, just as we've discussed on this call, hospitality, and other kinds of workforce engines are really, really important because you can partner with the city, you can partner with nonprofits that in CPLC's case, this is a great example. They've been in the community for 50 years. So that means that if you're taking on risk in a market where your objective is a 10-year hold, partnering with someone who's been there for 50 years actually reduces the risk for the investor. And if the community itself, such as the city, is stepping in with objectives and goals and how they're going to support that ecosystem, that also goes to further reduce that risk. And so what is really wonderful about opportunity zones, and I think the way that all of these funds are positioning the markets that they're in, is that they are looking to build a comprehensive long-term ecosystem that has other drivers. And sometimes that means supporting, that means bringing in the nonprofit. And they might come in and establish a beachhead right there next to or on or adjacent to your asset. So it's, I think that demographics really, really matters. And we are the beneficiaries where we all sit in Arizona of so much of the growth of the country right now. The Arizona Commerce Authority comes out with really great statistics in terms of where we're growing and how we're growing and what what industry is fueling our growth. And those are really, to the extent that that the OZ map overlays with that growth sector, it's really important for experienced managers to step into that space and deploy capital in a way that it delivers a really, really strong win for the investor and a really strong win for what the social impact objective is of why this tax treatment has been designed.
Okay, I want to ask a follow-up question. I want you guys to be specific, and you don't all have to tackle this one, but if you're a fund sponsor, what kind of information do you need from either a landowner or a company or a city or a business? What specifically do you need to know to decide whether or not to pursue the investment?
I will start here. This is Oliver, just because I was just there, and I'll just pop up first here. The most important thing is a streamlined entitlement process. Cities that are looking to expedite, that are looking to work with sponsors on an expediting permitting process. Think about it this: there are 8,700 zones across the country. They're all competing with one another. So it is really attractive to go into cities, and we have them on this call who are looking to work with developers and with developer partners to develop in a way that you might have expedited timelines. You also might have city participation as far as their workforce or housing objectives are, or other industry drivers. So I think city participation is so important, and particularly as you talk to rural communities, it's okay to dream big, and it's okay to set out what your objectives are for your community. And so that is a really important key. City participation matters, at least as far as Virtua's strategy goes, because we want the city as our partner.
So what about others? Are there pieces of information? I mean, I could see where this part matters, but are there other things you're looking at from either the landowner or the business that you would want to know when you were deciding that it's absolutely critical for you when deciding whether to invest?
For Caliber, we want to know what your vision is, not what you have. Don't call us and tell us you've got a piece of property in an opportunity zone. So does everybody else who has a piece of property in an opportunity zone. We want to know what it is today and what you feel, what you think it could be. The process of thinking through the vision and the imagination of that, and maybe taking some time to do some early renderings or do some due diligence on how you could get to where you would like your property to go, helps save us a ton of time on a very tight timeline where we only have 6 months to identify a project and 30 months to construct it, to get from where we start to where we need to go. So that's first and foremost. We need a really strong, what we call a back of the napkin. So hey, you can buy it for this, we can renovate it for that. We think we can get rents of this. We think that produces a profit of that. And here's the timeline we think we can get it done in. And here's the obvious things that we need to think about. Maybe we don't have enough parking. Maybe we need to go to the city for a property tax reduction, all the different things. So to the extent that you can have thought through some of those really basic things, that's what you need to have done. And then show us the site, and that's just about it. What we don't need is a 200-page proposal or 40 pages on the market statistics or whatever. If we know what we're doing as a developer and an investor and we're doing our job, we should know a lot of that information. So we'd much rather like to get engaged with you early and see how we can work together to make a good project go, than have you spend hours or weeks or months trying to build the perfect package.
I've also heard it said that the deals have to pencil out even without the opportunity fund tax benefits. Can you all talk about that a bit?
Sure, I'll just add to my last comment. This is Chris again. That the tax benefit of this program is driven by, like I said before, primarily the growth in the value of the investment. And so, unlike the traditional tax credit real estate investing that a lot of us have done, where you might do a project that has a minimum profit, but the tax credit creates a nice return on investment. In this case, if the project itself has a minimal profit, then there is very little, if any, tax benefit. And so it You just have to think differently in terms of looking at the project first and foremost, that it's a good, in our case, real estate investment, or in Jonathan's case, a good business investment or infrastructure investment that's actually going to generate a good rate of return and grow in value over time. And as long as it is, then the tax benefit follows.
Jonathan, did you want to jump in on this one?
Thank you. Yeah, happy to. And I'd say, before opportunity zones, there were certainly projects like providing housing to people below 50% of AMI. Those types of projects have always been challenging. They never penciled out. They would have required state or county or foundation support to make them happen. Opportunity zones are part of the capital stack. Maybe to a certain extent, it reduces the reliance on traditional philanthropy or reduces the reliance on county or state funding, but it's a complement to the other tools that are needed. It doesn't suddenly make housing at 50% of AMI suddenly affordable. I'd also add just that it really helps a lot on infrastructure projects too, because in infrastructure, so much of the return is driven by the tax depreciation benefits. You think about solar depreciates in 5 years, or broadband fiber, which depreciates in 10 years. Being able to use the depreciation tax benefit for your investors and to avoid the depreciation recapture upon sale is a huge incentive to using opportunity zone funds to finance these types of larger infrastructure projects. Also, just while we've got him here, one of our board members, Steve Glickman, who helps co-author the opportunity zone legislation, he's here in my office too, and I thought I'd throw the question to him now that he's had a minute here or two here to prepare. So here's Steve as well.
Hey everybody. I think what everyone has previously said is generally right. I think penciling out means different things to different types of funds and different types of investors. It's not a monolith in terms of how these projects are structured, and I also think the market is pretty dynamic. So as folks are learning about the marketplace, I think they're less likely to take as much risk from a return profile because there's not as much confidence as I think there's going to be in the state of the regulations and how likely fund managers that they're working with are likely to get the full incentive. And so their backstop is to bet on projects that have some kind of return profile that they're comfortable with given the risk. And these are typically riskier deals. They're private equity deals in developing places that have a long-term horizon of which you're going to be building something from the ground up or putting a lot of capital into it. So these are riskier projects. Over time, I think you're going to see the risk from the regulatory perspective or that perceived risk go down, and folks will then factor in some of the boost that this incentive gives you, which depending on your return profile can be quite substantial. It can be 300, 400, 500 basis points, 600 basis points or more. And I do think that people will start to factor that in. Investors will start to factor that in once they accept that there are models that work pretty well. But this is a new marketplace, so I think that's why you see some of that safety in expecting a certain return profile. But of course, there are now banks investing, insurance companies, philanthropy, CDFIs, and others who are willing to take lower return profiles regardless. So the market is as dynamic as any private equity market. This is just a tool to subsidize, like any other subsidy, just it works in a different way, projects. And I think there's a whole range of investors willing to accept different types of returns, and some that haven't really been formalized yet that will become much more common, like preferred equity returns that have certain caps that are higher up the capital stack, which you can do right now. It's just not that common in the market yet. So there's a big range.
So I want to ask one last question of the fund sponsors and Steve before I toss it over to the economic developers who've been waiting so patiently. And that is, how do you source your deals? And how would someone who has land for sale or lease, or a project seeking funding, or an operating business seeking investment approach you?
So I'm going to give you Brian's personal cell phone. Now, this is Chris with Caliber. I just wanted to add one last little comment to what Steve had just mentioned. And what we've seen is simply that, there are tens of thousands of projects across this country that are probably pretty good projects that don't get funded because they're in Tucson, Arizona, and they're not in San Diego. Okay, There's nothing wrong with Tucson. There's nothing wrong with San Diego. They're both great cities, but from an investor standpoint, San Diego is an obvious place where they can put their money and they feel like they're going to be safe. And in Tucson, they don't know Tucson. They've never been to Tucson. They don't know anything about Tucson, you know? And so oftentimes that's the experience we get from our chair is, you know, why would I invest there when I can invest in my backyard in San Diego? Well, this program, because of the tax incentive, has created enough incentive for the investor to say, you know what, I will invest in Tucson, Arizona. That sounds like a great place to invest because I'm getting this tax benefit. So the way I look at it from, you know, dealing with investors on a day in and day out basis and doing tours and bringing people into our fund is that they are making different decisions than they normally would without the tax program. And I think no matter where you sit in the food chain, you should continue to support this program because it is starting to create more volume of capital towards deals. For us, the answer on how to get to us is really simple. We have an email address that's Ozone Deals. It's OZONEDEALS @caliberco.com, which is CALIBERCO.com. It's our website. You send it to it. We have a whole acquisition team that sees every deal, including the head of acquisitions. He looks at every single deal. We probably get 5+ a day at this point in time, maybe even a 10 a day. And he looks at every single one of them. So if
All right, Chris, I gotta stop there.
likes it, go
Have you
for
done
it.
any of those over the transom submissions?
Oh yeah, for sure, for sure. We have in diligence, we have at least 250 million that have come in that way.
Really?
Yeah.
Okay. Oliver, how does this compare with you? If I wanted to attract funding from Virtua, how would I go about it?
So we have a very similar approach to what you just heard the team at Caliber say, which is that we have an execution team that looks at pretty much every deal that comes across our deck. The most important thing that I think for anyone out there who is on the call that has a parcel that they would be very interested in selling, or that they are a city and they're looking at the city land that they have that they might be looking to develop, is start the conversation and you've got to both be patient and persistent. It takes a bit of time to put structure around where parties are going to come together. I would say that if you're a private landowner and you're on this call, start thinking about the local nonprofits that you might start a conversation with about what their vision could be for your land. And that might be a university, that might be another nonprofit driver. And then that's a really great approach to come to a fund with. Start a conversation with your city. Sometimes that really provides a amplifier effect when it comes to what vision looks like. One of the things that we're going to see as the life cycle of funds moves across the country is that the tier one deals, Sean, just as you just said, are the deals that would have happened anyway. So the kinds of projects that you're going to see developed over the next 2 and 3 years are deals that really did have strong numbers behind them. It's when you start to have to dig deeper into the capital stack on tougher and tougher deals. You know, the big misnomer is that you have an ozone site and you think that it's worth a lot more because it is. I make you the argument, no, it's actually probably worth less, but the way that you can start to cushion value and change the and change points of value creation are with the partners that you bring to the table. And we really do think that 3 legs of the stool are required for any opportunity zone project to be ultimately successful, which is connecting your investor base with a local nonprofit partnership in conjunction with partnering with the local community. Those are really important legs to the stool. And so if you're the city on this call, the other 2 are really important. If you're a landowner on this call, the other 2 legs are really important. The same goes for the funds that are on this call. I mean, we are defining a landscape here, and we're doing so, I would say, you know, just because I'm very familiar with the funds on this call, with some of the best success in the country. This is some of the highest talent that there is in the country developing out their funds, and so it's really, really important to think with vision, and that vision requires either a city or nonprofits partnership.
And then can I ask Jonathan how this works for you, particularly with regard to operating businesses? How are you finding that deal flow? What do people do to get your attention, and how are you finding most of that?
Yeah, of course, we have the obligatory info at Arctaris email address, which we do read, and it's useful. You know, you might not get a response in 48 hours in every situation, but we do find interesting deal flow through info@arctaris.com. Our primary sources of deal flow are either economic development agencies, groups like Arizona Commerce, but in other states at the city and county level, or commercial banks. Frequently, commercial bank may be working on a project and they need some equity or they need some sub-debt to round out the capital structure. So given that our investors are primarily government agencies and commercial banks, it's helpful to have the relationships with those entities on both sides. A bank that's an investor in our fund is much more likely to give us deal flow too. And in theory, given that they have money in our fund, they also want to give us good deals and hopefully not the bad deals.
All right, give that address again for reaching out to you guys, the info address, Jonathan.
Sure. info@arctaris.com. That's ARCTARIS.com.
And Chris, can you give yours again?
Yeah, it's Ozone Deals, OZONEDEALS @caliberco.com, which is CALIBERCO.com.
And Oliver, do you guys have it over the transom email address?
We do. We use our standard communication tool that's right on our main page. It's virtuapartners.com. So please feel welcome to send us a note, and either I'll be responding to you or one of our other team members. The other thing that I'm thinking about, Sean, here, if it's okay to share for a moment or two, there are two inflections that are going to take place in this market, which will create even more capital and more project flow. Currently, 1031s are outside of the compliance window, so you've got as a technicality, a 1031 cannot be released for 181 days. Well, an OZ asset needs to be placed within 180 days. And so Senator Tim Scott I know has as a goal to correct that legislative text in the next appropriation cycle, hopefully later this fall. The other is the way that large money center banks who may have raised OZ capital from their own client base operate the market. So currently they're largely limited in terms of their own manager selection and their own fund management. But there will come a day in time where the large money center banks are permitted to invest with outside funds. And that is going to be a game changer, I think, in terms of the velocity of capital that gets placed towards projects. Currently, all of us are raising from equity partners through our own relationship network, whether it be through broker dealers or the family offices or ultra high net worth investors that we've worked with for decades. There will come a day in time when a Wells Fargo account holder who may have talked to their investment advisor about an opportunity zone asset is going to have the opportunity to have direct parsimony with all of us as funds. And whether that happens in conjunction with Senator Scott's work on the legislative text or next year, that is going to be a really big moment in terms of capital flow.
Okay. I have to say, I was about ready to toss it over to questions to the economic developers, but Bill Jabjiniak wants to turn it on its head because he's got a question he wants to ask.
I've got a question for the funds here. So again, Bill Jabjiniak, City of Mesa, Arizona, right? Mesa is the 35th largest city. It's 500,000+ people. I don't enjoy the same brand recognition as the city of Boston, where Jonathan's sitting today, right? So, my question for all of you is, what kind of international interest are you getting in what I call a secondary market, like for a Mesa? Because what I'm starting to get wind of is international money starting to show up that may look for places to park for a while. and they know Boston and they may know San Diego, as Chris mentioned earlier, but they don't know Mesa. They're asking a lot of questions. What are you seeing in the marketplace?
Bill, this is Oliver here. I'll only because I'm wheels up on Friday to Europe for 10 days to actually talk about opportunity zones with lots of different stakeholders. The transatlantic relationship and the trans-Pacific relationship is beginning to become more familiar with different markets. And while foreign capital cannot receive the tax treatment because, of course, it's taxed very differently. The way that opportunity zones are starting to change the broader portfolio landscape is the broader impact, I would say. So whereas certain submarkets may not have been attractive before, different funds and all of us are saying, well, we've got this holding here and we've got this holding here, and there are other ways to participate in the capital stack that might not have the OZ tax treatment. So I would just say that it's part of the economic growth that we've seen over the last few quarters. It's also seen in a relative context. We're seeing major slowing in European economies, some even participating at negative interest rates. And so the U.S. real estate market is still a very attractive play. Pacific Rim investors are most comfortable with it, but there are lots of European investors as well.
I can add one more thing to that. This is Chris with Caliber. So we have funds that are not just opportunity zone in nature. We have, traditional real estate private equity funds. And so for investors outside the country, they can come to us and invest in real estate, and actually some of our investors, I think, have some U.S.-based capital gains, which they could put into an opportunity zone fund if they wanted to. And so, so we do experience investment primarily from Canada, a little bit from Asia, mostly from kind of, some from Boston, which is foreign. No, I'm just kidding. But in most cases, it's sort of that Canada. We tried to build out a pipeline to Mexico because a lot of Mexican investors wanted to invest in Arizona. But what I've found most often is that there is definitely more money coming from foreign markets into places like Mesa, places like St. Louis or Kansas City, or all kinds of places, because at some point in time, some of those primary markets do get overheated in pricing. But it's very hard to, in an organized manner, get your arms around from where. I mean, as soon as had we spent a lot of time at Caliber building an entire pipeline for capital from investors wanting to come from China, well, I mean, they've totally changed their behavior in the last, call it 8 months, and that would be a total waste of our time and resources. And so it's hard to always be ready for the investors wanting to come from wherever it is that they're coming from, for whatever reason, that they decided to come to our state. As a small example, if you think back to 2009 and 2010 during the financial crisis, strangely enough, there was a massive influx of capital from Australian investors buying foreclosure properties in the U.S. because there was some real estate guru in Sydney running around talking about how cheap real estate was in Phoenix, Arizona. And it was at a high in Australia. So, sometimes it's very hard to predict where it's going to come from. I know that doesn't really give you much value. I've seen that there is a trend of foreign capital coming more towards, what I would call secondary cities. They should certainly come to Mesa. It's a wonderful place to invest. But I can't help you there on our side.
All right, I'm going to shift us back a little more to the opportunity fund investing. And I want to throw this one out to Steve. And this is sort of the flip side of the question that I had asked about deal sourcing, which is for economic developers at the city and community level, how do you let funds know about investment opportunities in your communities? What types of marketing are you doing? What's worked? What hasn't worked? Has your approach changed over time? Give us some insight into how you are drawing attention to the opportunities in your territory. Steve, can you fill us in? Steve, have you muted yourself? Because I can see you, but I can't hear you.
Does that work?
There
you go.
Yeah, can you tell us Can you tell us about how you are marketing opportunities in opportunity zones up your way?
Yeah, I was just asking the question, does blind luck count?
It never hurts. It's a
So-
nice add-on.
So we have front-loaded a lot of infrastructure development. I mean, if Mesa's a secondary market, we must be quaternary or something like that. I'm not quite sure. A town of 12,000 people in a rural area of the state, we had done a bunch of front-loading just out of instinct that we needed to be developing out some infrastructure. We had expanded the sewer system a few years back. We received $75 million to build out the State Route 260 corridor into a 4-lane modern roadway with all the access points developed out of it. Those were huge strides forward. We had worked with ACA on developing a road project here, which led to one of these business parks projects that came out. We had some investors prowling around about the same time that the OZ was designated for Camp Verde. And although they had been looking at one project, the opportunity zone opened up really the floodgate for them to invest into the two larger projects, which is the 80-acre business park and the 175-acre home facility or home project. So we hadn't really done any particular marketing. Most of the marketing that I do now has been sort of running the circuit and getting to know some of the investment funds. I've met the folks from Caliber, I've met them from a couple others. We have a local funder here. I recently, this newest investment is a guy and his brother who happened to sort of stumble on Camp Verde, quite honestly. He bought a house up here and then started looking around and saw what was going on, saw the OZ over here, got to talking to his brother and decided to move their manufacturing plant from California into Arizona and a sister market or sister manufacturing facility, which is currently in Mexico, and bringing them up here. What we've marketed is that we have some very low cost properties. These 80 acres, which is the State Route 260 and Interstate 17, was sold for less than $25,000 an acre. A very good deal was given the guy on the smaller piece of property, complete with 3-phase power on it, all of the infrastructure there to it, and thanks to ACA, at least the conduit down which to stick a piece of fiber optics. So those projects have now opened the door to a bunch of smaller ones coming in here and paying attention to it, basically through word of mouth. I honestly haven't had to go out and hit the streets with it because it's really difficult from a rural area to go, where do I put my money? I am working with ACA right now to see if we can't tap into some of their recruitment efforts in California to fill up a couple of these other business parks. Other than that, we market ourselves as a great place to live. An hour from Phoenix, an hour from Flagstaff, an hour from Prescott, on an interstate highway with a climate that's 10 degrees cooler in the summer.
That is a big appeal at some parts of the year, to be sure. Bill, how does this compare and contrast with your experience in Mesa?
So for Mesa, I think from a marketing perspective or from an overall, how do we attract funds? We've really looked at this and stepped back and say, all right, first of all, how do I educate? I've got capital that's active in the marketplace. How do I educate those brokers and those capital investment people about opportunities that we may have? So a lot of the fund managers is a target. We also step back, and I think the real estate brokerage community has a lot of relationships. So we work with them quite a bit to talk about what part of the city, what type of product they're interested in, and then we'll focus them on what the goals are for the 4 different regions of the city. We then do some direct outreach, which has been primarily local and some interactions. I have to do a better job on a national scale, but I think we're seeing, Greater Phoenix in particular is in, expansion mode. How do we keep that going? I think opportunity zones is one way to really look at that. And then the last thing I was going to mention is our partnerships, whether it's with ACA, GPEC, East Valley Partnership, a variety, just talking about that at various opportunities has been actually paid off very nicely for us. So those are 3 different things that how we let some funds know what's going on.
I want to add one thing, and I'll let you jump in a second. I had asked Aaron White from Avondale to be with us, who's been working with Virtua and others in his West Valley community. Unfortunately, he's on a plane right now, but he actually sent me a written answer to this. So I want to share that. I'm not going to try to do Aaron's voice, but when I asked him about how they let funds know about investment opportunities in Avondale, here's what he said. He said, the Avondale Economic Development Team has created a website and flyer that describes each of Avondale's 3 opportunity zones. The flyer highlights developable properties within each of the zones. Each of those properties shows the land use, zoning, co-tenancy, and water and sewer line locations and sizes. This flyer is distributed and referred to in all our one-on-one meetings with potential investors, developers, and brokers as appropriate. Together with Westmark and other West Valley cities, Avondale led the effort to host an Opportunity Zone Forum in February. Over 100 people attended, and many of the West Valley cities were given the opportunity to promote investment in their zones. Our mayor has received a substantial amount of earned media, principally thanks to our partnership with Virtua Partners. He has been highlighted on NPR, the New York Times, Phoenix Business Journal, Curb, and others. He was also asked to speak at a session of the League conference regarding the topic. The city of Avondale pursues only limited paid advertisement, but an advertorial in the AZ Republic highlighted Avondale and its opportunity zones. Though earned media gets us clicks and notoriety, our best results have come because of building on existing and creating new relationships with investors, developers, wealth managers, business owners, and brokers. Avondale approached the opportunity zones with a hope for new commercial and industrial development. We have seen 268,000 square feet of industrial space be permitted in our historic Avondale zone by an out-of-state developer. Also, Portillo's has opened their doors in the 99th Gateway zone. However, we have seen the market veer towards multifamily and hospitality development. We have seen 2 hotels break ground, 1 multifamily apartment complex held a ribbon cutting, and an assisted living project open their doors. Other projects are working their way through zoning and site planning processes that will result in more hotel rooms and apartments. As a result of the market pivot, we have been promoting sites in Avondale that are more conducive to current market trends, whether they be in opportunity zones or not. Our focus continues to be on the Gateway 99th zone, given the strong market demand for the area with projects like Portillo's, Home 2 Suites, Marriott, Spring Hill Suites, and others. So I just thought I would share that perspective.
Chris, I'm going to jump in before you do. I think that web presence, I know we jumped out early and developed that website that's specific to opportunity zones as well in Mesa. But we actually put up the prospectus that actually will identify in detail what resources are there. And maybe we need to go even deeper, I think, into the future. But there's a lot of infrastructure already existing in Mesa. There's pockets that still need it too. But I think having that out there, because we have found working with a variety of folks over the years, a lot of research is done before they ever pick up the phone and get to us. So I think that web presence, that marketing, that prospectus, social media is a big piece of this. I've even taken our newsletter and have a couple of featured articles. If you haven't read it, look for the Quick Jab in the Mesa Economic Development newsletter. Quick, cheap plug there, but I got it done. But the earned media that Aaron mentions is very true. And a lot of it's been very good. And sometimes we've taken a ding here and there too for some of that media presence that's out there. But there's a lot of discussion that goes on about opportunity zones. There's still a lot of unknown questions that are still hanging out there. But that's so important to have that web presence.
Yeah, I think that everyone here wants this program to be successful, at least on this call for sure. And everyone listening in is probably thinking about how they could use opportunity zones to benefit them in some way, shape, or form, right? And what I had mentioned before about there being thousands of projects that are viable that make a lot of sense. Well, what's the constraint? The constraint is the capital. If you look at it from the city's perspective or from a developer's perspective, at the end of the day, there's always the same issue when it comes to investment, and that is raising the capital into a new program that no one's ever heard of before. Investing in businesses is different, but investing in real estate is very local. People like to invest in their own backyard. And if you put yourself in the shoes of the average investor who's got a capital gain and is trying to figure this program out, you very quickly come to a point where you say, this is just too complicated for me to think about. I can't think about 10 years, a 10-year commitment. I don't even know how to think about what that means in terms of what decisions I'm making on doing a single project or multiple projects or a blended fund, or should I invest in Mesa or should I invest in Tucson or whatever. And so there's not a lot of support infrastructure for them to go to an expert and then help them digest that down to what it really means for them and their personal situation. This is probably a problem that fixes itself because, as Oliver mentioned, some of these wealth management complexes like, Wells Fargo and, you name it, Morgan Stanley, whatever, are finally starting to adopt opportunity zone funds and bring them to their investors and teach their investors about it. So I expect the capital flow to be pretty high next year in terms of people actually making investments in the funds. But for those of us who are in the city or in the developer chair, you're really just hoping us funds raise the money so we can get it into deployment, because as much as, like you said, you put up the website, Bill, you put up all that information, it's great. There's a lot of projects on there, but until I get more capital inflow, I'm already full,
Right.
And so the only thing that the question then becomes, well, what could you do? What could you do that's different from anything we've ever done before? And it's to have that really awkward experience of promoting the idea of investing in a fund or in funds. The one thing that the larger, the municipalities have access to, et cetera, is, the business community, who owns companies who might actually have these capital gains, and these people want to invest in your own backyard. But there's such a disconnect between someone like me and them that it's sort of haphazard how they find us, how they get to know us, et cetera. If we were actually putting those parties together, we'd be raising capital faster because they do want to make these investments. They just don't know where to go. And I mean, Caliber's put out hundreds of thousands of dollars of advertising and marketing, if not millions, in terms of press and that kind of stuff. And yet, we still don't have direct outreach from certain parties who should know that we're one of the largest funds in the Southwest, right next to Virtua and some of the others. So it's really interesting to me to see how many people I meet on a daily basis that are like, oh, I didn't even know you guys exist. But, oh, I had my capital gain 2 weeks ago. I can't invest. So that's a pretty common experience for us right now.
Yeah, this is Oliver here. I'll show educating the broker-dealer community and the legal community has been just as important, because if you think about the different access points that capital may have before it reaches a destination like an opportunity zone fund, there are lots of validators, and some of that has meant in the broker-dealer community a lot of education. I spent most of all of last year going to due diligence conferences, just familiarizing the broker-dealer community with this concept. And I would say that I've spent most of this year working with groups like the Institute for Private Investors and the Family Office Exchange, and sort of where sort of family offices go for guidance and best practices. But really, to the point here is that it was not until a month ago that the Institute for Private Investors held their first conversation on opportunity zones, and then immediately after, there's this floodgate of interest, and some of it just might be interest that that capital doesn't just originate to be able to place. Then the family might say, what if we position this asset for sale? Because we have some more optionality than we otherwise might have only had with a 1031. So really, the life cycle of how these relationships develops is not immediate. A huge investor base that we find sort of comes to us is doctors or lawyers that are closing up a practice. They've incurred a huge gain, and they're looking for an immediate placement. But otherwise, it's really an educational process in developing trust and relationships with family offices or more institutional oriented investors, where they're going to go through a broker-dealer, and then it's, will that broker-dealer be able to have the vernacular to be able to really talk about what the products are. So we are on the right side of this curve, and I'd say that the group on this call, in every hat that we all wear, has done a really good job over the last many years, familiarizing our constituencies with this program and its possibilities.
I'm going to stop for just a second and say we're halfway through. I want to keep encouraging people to submit questions. I see them. We'll incorporate them as we go. I do want to ask a couple more questions of our economic developers before we kick it back more toward the funds. And that's, for the economic developers, have you seen more local opportunity fund interest in your zones, or has the interest come from outside the area? And has working with opportunity fund investors been any different than working with non-opportunity fund investors. Bill, you want to start with that?
Sure. So let me start in reverse here. Has it been any different than working with other investors? I would say not really. I think what we're seeing is, and as you know, doesn't opportunity funds don't make a good deal better, or will make a good deal better, but it does not replace the real estate fundamentals. Let me get that correct here. But what we're seeing though is that increased interest that has now prompted different types of development. So, I think from a local perspective, doing a lot, obviously, with Chris and Ryan and caliber companies in general. My goal now is to get them to expand to another part of the city. That would be a local goal. But what we're also seeing is some different funds from across the country. And I've had one international inquiry that it does appear he's got some capital gains incurred here that they're looking to do something with. So it's a little bit of mix of both. Again, we're still in expansion mode. Capital is looking harder into what opportunities we have, and it really depends on where the fund's focus too. Is it focused on housing? I'm going to send you into downtown, and I'm going to send you down to the Fiesta area if you're focused on housing. If you're focused on industrial, I'm going to talk about both Gateway and Falcon Field and around both airports. So it depends on where we're at. There's more adaptive reuse in the west side of the city. So, I've got somebody poking at how do I take empty shopping centers using the fund and making some things happen. I think that's fantastic. So a little bit of both in some areas.
Steve, what has your experience been? Are you getting local or outside interest? I know you've talked about this a little bit. And is this any different than the economic development work you do with non-opportunity funds?
I'd echo what you just said, that we really haven't seen a fundamental difference in the investor. Echoing again, this is not going to make a bad deal a good deal, but it'll make a good deal a better deal. I think that fundamentally, we still do the same work out of the office. Fundamentally, we're still telling the same story. Fundamentally, we're still presenting the same vision to the town, to those who are potential investors here. So in that sense, I'd say there is no difference. As for local investors, I have one small, recently started local opportunity fund. And that fund has its first business project, which we just had a development meeting on the other day. I've known the guy for a long time. He's very astute and very much a guy I look to assist us with some questions about opportunity zones, as he's now managing one. From that standpoint, he's a great partner to have. But that's my first local one. The rest of them are all out of state. As a matter of fact, Minneapolis, Minnesota is the largest investor in Camp Verde right now.
So I will tell you, I also posed this to Aaron White in Avondale. And what he said was that the interest has come principally from Arizona funds such as Virtua. He said, at first I tried to cold call several newly formed funds across the country with very little success. Other out-of-state developers are looking around Avondale for potential investment opportunities, whether in opportunity zones or not. When I asked him if it had been any different, he said, there has been very little difference in working with the different investor types. As we meet and discuss, we fluidly talk about investment opportunities, both inside and outside opportunity zones. And that sounds pretty familiar. So I want to flip back to the funds for a moment and ask, what has been your experience working with cities, counties, and communities as you have developed projects? What has worked well and what could be improved? And Jonathan, I wanted to see if we could start with you, because I know that you do work on infrastructure in particular, which I have to imagine involves a fair bit of community and county regulations. So I was hoping you could speak with what your experience has been like working in the communities to get projects done.
Sure. We look at community engagement as a strategic benefit to the projects that we do. To give an actual example, this is something that came up, small town in Maine, rural area, no high-speed internet access, but it happens to be in an opportunity zone, and we put together a package that included both New Markets tax credits and opportunity zone equity capital to bring broadband to this town. I think when you look at the town and the demographics, it's easy for someone, you don't need a broadband PhD to understand why they don't have access today. The people who live there, relative to other parts of the state, they don't earn much money, and they also don't live close to one another. So for Comcast or Cox or anyone else to come in there and lay fiber, it's a very low ROI, maybe even a money-losing investment. So how do we approach something like that? Well, I mean, clearly cost is a big driver, and then revenue is a big driver. What can we do as infrastructure financing providers in order to increase the take rate and the targeted long-term revenues of that type of project? A big thing is community engagement. It sounds crazy, but having a town hall meeting helps our network operators and architects figure out, okay, you know, over here in this part of town, in the not too distant future, there's going to be a significant need for businesses that are developing that are going to need internet access. And over here, you've got telehealth, and this is the direction where the community is growing. So there actually is an important feedback mechanism in these types of transactions. But the bigger picture, and I think some of the secret sauce really comes from the community engagement itself. You know, nobody's going to town hall meetings and asking local residents for their opinions on network architecture or what kind of switch to use or what kind of gauge fiber. Really, it's more about community engagement. When the community is involved and consulted on these types of projects, they're much more likely to want to use them. You know, this is the broadband network that we, our community, brought in. It wasn't some, you know, out-of-state van that came in and laid fiber and then they were gone. This is community-driven broadband. And I think you can apply that same kind of methodology to other types of infrastructure projects. You know, whether it's parks and planning or seawalls or solar farms or disaster resiliency, those kinds of projects, in each of their own ways, having community engagement improves your strategic positioning with customers and suppliers. So we do encourage that. It's actually part of our mission mandate requirement with many of our foundation supporters and guarantors for the fund. So, you know, we're big believers in that. You know, some of the other pieces would be more, you know, I think on the side of working with mayors, county executives, and in some cases governors. You see many communities which, you know, let's say your tax revenue base isn't as high as you wanted it to be. Universities, nonprofits, and development authorities have been buying up all my land, so my city's tax revenues have been declining over the last 10 years. But at the same time, I've been kicking the can down the road, deferring maintenance on my wastewater treatment facility, or I know I need a new fire department, but I don't have the budget to do it. And I don't want to issue muni bonds because I don't want to get a credit rating downgrade. In those kinds of situations, we can actually work with the mayors to improve their own fiscal situation. Instead of spending $25 million in next year's budget to fix your wastewater treatment facility, an opportunity fund came in. They bought the wastewater treatment facility from us. They paid for the upgrades, you know, and most likely we put in solar to power the wastewater treatment facility. And then at the end of 10 years, the city or the community is going to buy that asset back for a predetermined price. It's very much like a muni bond, but it's not a bond, it's equity. So these types of things, it really is engagement with the community to help figure out what things are most important to the community, what things are most important to the mayor, and how can we help you accomplish your objectives.
So Oliver, what is your experience? Thank you, Jonathan. What has your experience been in working with cities to get through permitting, to get through infrastructure needs, to get through any reviews you need to get through? Has it been good? Has it been bad? Has it been in between? Are there things you see that need improvement?
We have had very, very strong working relationships with mayors and city management teams, all on this call and others around the state. I've got to say that Arizona has, I mean, because we work in 31 states or across the country in opportunity zones, and Arizona is one of the top markets. There is a culture of working together that we've really got in Arizona that is important to acknowledge. I had the opportunity to join my CEO, Quinn Palmino, down in Tucson this past summer for the Arizona League of Counties and Cities. Really constructive dialogue. The mayor of Avondale joined a panel conversation. It was hosted by Westmark. It was wonderful to start to hear rural teams start to also see and hear best practices that might make for a really competitive offering. And there's been a ton of great follow-up from that. So I really do want to compliment the teams in Arizona for their forward-leaning approach in terms of really working out there to design this. Sean, I think some of the credit really goes to the Commerce Authority, where you've educated, and the governor's office, who has worked very hard on making sure that resources are out there and dialogue is out there, just like this call. This is wonderful to be able to have these conversations and bring parties together. I would say that the biggest bottleneck that happens, which is really a non-starter, is this conversation about additional infrastructure that might be required, such as power or sewer or other services that it'd be additional cost to develop out a site. And so it means really thinking flexibly, just like we heard in terms of it's not a muni bond, but it's working with equity to provide a long-term community solution. You know the time horizon. It's a decade. You can predetermine the price. That's a really elegant arrangement for a city to be able to improve the lives of its citizens. And so collaboration is really important, and to work at the table and to start to say, I mean, there's that great line that Rahm Emanuel, as chief of staff, used to say for President Obama, which is that for parties to be able to work together, they've got to be able to put points on the board. And that's the most important piece of this discussion between equity and a city and the nonprofit, if they can be president. Everyone start putting points on the board. And once you've got that dialogue, a lot becomes possible. And to make sure that the team that you're bringing in is a sophisticated tax team, because tax strategy is what this is all about. And so I mentioned earlier, by partnering with a nonprofit, you can actually amplify the tax treatment of a deal. And so there's really important value to that nonprofit in the capital stack.
Another question.
Yeah.
I want to do a whole thing on that one, so I'm going to stop
save
you
that
on
to
the
next.
tax advantages with nonprofits.
So, Sean, can I address from a city perspective some of the infrastructure and partnership?
Sure.
So, at least at the city of Mesa, first of all, I think anybody in the economic development world is going to tell you that economic development is a team sport. So you have to have a variety of partners. And for us, I know at the city of Mesa, and this really should go for any municipality really across the country, but any municipality should be able to do two things. One, invest in infrastructure to help bring a development to your community. Two, cut the entitlement risk. So a couple of examples, 8 years ago, I think the city, maybe even 10 years ago, the city put a road in on the north side of Gateway Airport. Today, it's probably got 15 buildings under construction, and it's in an opportunity zone. The other thing is we have developed in a variety of parts of the city, not in every opportunity zone, but a variety, a way to take the entitlement process from 6 months to 6 weeks. That says a lot. That, I think, is a great opportunity for businesses. And that, again, is not in every opportunity zone, but it's in parts of each one of them. And I think when you look at form-based zoning and zero lot line developments, those are all things that save time and thus money and help a development come to fruition. And those some of the partnerships. I know we pulled our electric provider in on a variety of projects to solve making sure you have enough power at the doorstep. And that's so important. And it doesn't come out of the project budget. It came out of, in this case, SRP's project.
I think those are the most effective things we've seen recently, and some of the stuff that we're working on is the incentives that are able to be decided on fairly quickly that reduce the equity requirement of any project, allow us to green light a project faster, because we do have to create that upside value for the investors. And if it's a marginal deal and it's like, but if the city can step in and say, you know what, we'd like to own the parking, we'll put in 2 million for the parking or whatever, then the project just gets done and it moves very quickly. To the extent, that we've had the ability to do that or think creatively about how we could do that, accomplish that. Because, a city or municipality can take something and say, look, a revenue stream we can take over 30 years. We can do, we have a lot more flexibility. The problem with opportunity zones, which it seems like we're leading our way into, and is I got to get built in 30 months. I don't have time to talk about, how we can strategize about parking for the next 3 years. We got to get it done. We got to go quick. So that's the requirement of the law. And the fastest way to do that is to provide a little layer of equity capital in the form of maybe taking a cost off the project or taking some taxes off the project for a period of time, those types of incentives that work in private development outside of opportunity zones make the opportunity zone projects even better, because the opportunity zone projects have a 10+ year outlook versus the other private projects have a 3 to 5 year outlook. So, if 50 grand a year of cost savings is going to create a bigger piece of momentum for an opportunity zone project with a longer outlook than a non-opportunity zone project.
So I'm only going to ask a couple more questions, and then I'm going to turn over to the questions that we've got coming in from our listeners. And some of this has been alluded to in some of the stuff that Aaron submitted from Avondale. But I'm curious, both from the economic developer standpoint, did you get the kinds of investments you were expecting? And if not, what was different about what you attracted from what you were targeting? And conversely, for the funds, we've obviously seen regulations and rules roll out from Treasury over the past year that have given some more guidance and I wouldn't say a lot of guardrails, but some parameters for the program. Are you doing the kinds of deals you thought you were doing, or has your portfolio turned out differently than you thought it would? And Steve, can I start with you on this one?
Yeah, I would be glad to. We had 3 basic needs in Camp Verde, and honestly, each one of the projects satisfied one of those. We have a tax base, which we were trying to grow. We do not have a good retail trade here because most of that is in the Cottonwood area, which is the business center of the Verde Valley. So we had to figure out how to overcome that hurdle. That RV park project at build out should bring in somewhere around $400,000 a year in revenue for tax base. And that was a huge obstacle to overcome for us. The other was the notion of better paying jobs. The 2 industrial parks, one of which is working on a 100,000 square foot warehouse project, the other one is working on the 2 manufacturing facilities. We anticipate if all 3 of those projects get pulled off, they will bring in around 150 jobs, paying a good market wage, definitely much in excess of what the average wage is here in the Verde Valley, or in all of Verde Valley, much less Camp Verde area. So we think it'll satisfy that need. And the last one, of course, is the housing. It is a manufactured home community. The price point on those is under $200,000. That's an affordable house for just about anybody up here and for most of the jobs. So all 3 of our targets were hit with the first 3 projects that rolled out. So from our standpoint, this incentive program has been a game changer for us.
So from Mesa's perspective, we are seeing investment in our opportunity zones, which is fantastic. Just not all of it is being financed with opportunity zone funds. Again, you're in expansion mode. You're seeing a lot of capital flying, just not a lot of OZ funds. I think that's changing as we speak, because I do blame the delay in rules and guidelines for a big part of that. There was a lot of people on the sideline anxious to go, but weren't quite sure, and they nosed their way into it and kept going, saying, there's that much demand, we want to go. I'm seeing investment in manufacturing, for example. And every manufacturing job creates 4 indirect jobs. That's the type of investment we're looking for in certain areas. I think as you look at downtown, you're starting to see some different types of investments to help to activate downtown. Our downtown doesn't look bad. It needs activation. You need people who live there. You need the housing, the retail, the restaurants will come, the office piece will be another part of that. So we're getting the kinds of investment just slower to come than we expected along the way.
Okay. So Chris, from what you thought when this bill passed in December of 17 and you started thinking about a fund to today,
Yeah.
how has your thinking about what your portfolio is going to be and the actual development of your portfolio differed from what you would have expected almost 2 years ago when this came to fruition?
So I'll talk about the projects first because that's a very easy conversation. All 4 projects that are in our fund, which includes 9, soon to be 10, maybe 11 buildings in Mesa, have been fantastic. The return profiles are awesome. They're right in line with what we do. Normally, the community engagement has just been fun. You know, we're much more connected to economic development, to the city, to the local community. We just did our thing in our own little box, and which was successful for us, but you know, it's rewarding to be more connected to the wider world that we're affecting. So the projects is an easy question to answer. It's exceeding expectations, especially in the deal flow and the types of projects we get to see. On the capital side, we spent most of the first part of this webinar talking in some way, shape, or form about different forms of infrastructure. Well, capital has infrastructure too. Capital flows like a river, and you have to direct the water, and you have to lay the pipes, and you have to put in the switches, and you have to, you know, do all these different things. And so the capital infrastructure needs one thing most importantly, and that is extreme certainty of knowing exactly what is coming next, you know, in terms of the rules and whatever. And so the lack of guidance means that, you know, all of us could do math in the fund business. I did the math on the tax benefit and I said, this is going to quadruple the size of our company in a year. Well, it's not going to quadruple it. We're raising capital faster than we've ever raised before, so that's good. But we're not even close to what we were expecting. And I think a lot of that has to do with, because of the uncertainty, the people that investors are relying on most, which is their CPAs, their lawyers, their wealth managers, those service providers that are the ones that they look to for guidance, especially when you're dealing with a highly complex long-term investment. Those people have basically said, well, we'll see what happens. And now that these things are finally starting to happen, they're now finally trying to get up to speed. They're coming to us. They're looking for education. They're looking to understand how to talk about opportunities on funds to their clients, which is great. But it's 18 months into the program. We've lost, you know, a lot of time. And so I have hope that our wise legislators will find a potential fix in going back to the bill and saying, maybe we should, you know, lengthen the amount of time people have to make a decision on investing in an opportunity zone, because the whole purpose of the legislation was to get capital into these communities. Right. You know, putting an arbitrary 180-day clock on doing that is not really accomplishing what the legislation was trying to accomplish. And saying to someone who had a capital gain in 2018, well, you didn't get invested within 6 months. Well, we didn't even know what the rules were until 14 months down the road, you know, and keeping them out of the program at this point in time and not letting us go back to the people in 2018 and say, hey, you sold your business in 2018, come invest in an opportunity zone fund. It's not accomplishing any real goal for the country in terms of what the legislation was out there for. So I have some faith that that's going to change and that hopefully that they're going to go create that opportunity. But on a go forward basis, you know, our funds are now up on custodial platforms at Schwab and TDA. We're starting to work with wealth managers. We're trying to help teach them, you know, about opportunity zone funds. And I think the capital flow will increase substantially over the next year. We just thought it would have happened this year.
Jonathan, can I ask you what your experience has been? Are you doing the deals that you thought you were going to be doing? Are you doing different deals than you thought you were going to be doing? How much does your portfolio look like what you expected when you started?
Yeah, I think we're getting a little bit more into infrastructure deals than expected. Figured we were going to be about 2/3 private equity operating businesses, 1/3 infrastructure, and right now it's about 50-50. If I had to guess, it'll stay at about 50-50, but you know, in general, we're pretty close to expectations on this. You know, I'm interested to see what happens because you know, clearly there was a lot of emphasis, as we all know, originally on the real estate side of opportunity zones, and we've seen statistics on housing prices and multifamily and other projects going up higher. I mean, you have an initial land purchase, which tends to compress your overall returns. As yet, we haven't seen price inflation for the hypothetical machine shop in an opportunity zone, or building a fire department or broadband fiber. We haven't seen the price inflation just because these things happen to be in opportunity zones. But I'm beginning to wonder if maybe we will go in that direction as more opportunity funds get involved in traditional business-oriented private equity. Remains to be seen, but we'll certainly be tracking that.
Oliver, in the interest of time, I'm going to cut you off from this one, but I want to throw it to you with the next question, which is, can you talk with us about working with nonprofits on projects? I'd be curious how that's gone, what the nonprofit's role has been, and what the benefits are of working with a nonprofit. And I know you had started talking about the tax benefits of that earlier, and I said, no, wait, we'll come to a whole question on that. This is the
Yes.
time for the whole question on that. So if you can talk about that. And
Sean,
I wish Patrick were
thank
here to give their perspective, but please give us a window into that.
Yep, absolutely. And Sean, thank you for the question. I'm going to have to step off at 40 after, so this may be the last time you hear my voice. So I'll just say thank you to all that attended today, and thank you to the other participants. As you start to dig into the life cycle of what this 10-year window will look like, and I'll start by saying that Shay Hawkins, who runs the Opportunity Fund Association and authored the language for Senator Scott, and is currently driving a bipartisan coalition across both houses of Congress and different agencies, really is a key line participant in the interagency working group, is working on extender language, and it will likely be proposed by Democrats, largely driven through the Congressional Black Caucus. So we have worked aggressively. I serve on Shay's board. We were early supporters of the Opportunity Funds Association for the purpose that we really wanted to reduce the political risk that existed in this asset class. Shifting over to where nonprofits play in, and so this is really why the extender language is important, but also how deals that otherwise would not get done, that otherwise would get passed on. These are census tracts, and the tax advantage is there, and there's more tax advantage to be gained. A couple of other funds have used the word stacking today, and stacking is really important when you start to think about how you're going to build a capital stack. By bringing a nonprofit to the table to contribute whatever it is that nonprofit does, they might want to provide child care services in a housing project. They might want to provide an internet cafe, or they might want to take on a tenancy for the life cycle of the 10 years to reduce the risk and perform an underwriting function. They might want to participate in the equity position of the capital stack. They might want to weave this into their business strategy as a nonprofit. The beautiful thing that happens is that not only just nonprofits, but really any tax-exempt entity, so think of your pension funds or any nonprofit, any tax-exempt entity can partner with equity and reassign its tax treatment that it's not going to be able to take anyway. So it can reassign its tax treatment to the taxed equity. And that can further magnify the way that the taxed equity gets treated in the capital stack. And when you start to think about long-term depreciation in assets like hospitality, when you start to think about accelerated depreciation in assets like hospitality, or long-term gains and losses in a portfolio, you can really start to be creative with the tax advisor on, and we even see this with certain family offices that invest. The family office will invest, let's just pick a random number, $5 million through taxed capital that is seeking the tax treatment of the gain. And then the family foundation will sidecar $5 million with social mission paired to that project. The family office can absorb the tax treatment that the tax exempt capital it can't use anyway. And so it's a really creative way for the long-term life cycle. And I would imagine that most of the funds out there are going to be putting on their training wheels in terms of how they're going to interact and work with nonprofits over the next 18 months. But the projects that will get done in the second half of this 10-year window will likely all require some form of nonprofit participation to make the capital stack that much more attractive and the project work. And the beauty of this is that the purpose of the tax capital is social impact. And what do nonprofits do? Social impact. And so you're really reducing the risk of the overall asset, and you're giving it strength that it otherwise might not have ever sought the partnership for. So I get asked a lot because nonprofits go to different forums around the country, and they might be really interested in workforce. They might be really interested in second chance hiring. They really might be focused on some sort of medical need in a community. All of these are fair game. Any nonprofit that you enjoy working with, and the more experience, the better in terms of reducing the risk. But it can be a really strong capital partner in the capital stack. And whether they're contributing directly or they're just providing an opportunity for investors, potentially position social impact. You might have 3 or 4 social impacts sidecarred to a different project, but it's the tax exempt, and this is also going to be a big game changer when pension funds and Treasury starts to allow that community to invest and place into opportunity funds around the country. So I don't envision that language is going to come out in the next 6 months, but 12 to 18 months might actually be pretty reasonable in terms of thinking about it. That's something that I've had the conversation with them. I know some others on this call may have as well, but with the Treasury Secretary himself, he is fully aware of this, and he understands that the long-term life cycle and the success of that sort of second tranche of deals in the second half of the 10-year window is really going to require tax-exempt capital to work.
Okay, thank you for that. I appreciate it. I'm going to start taking us through some of the questions that we have from our listeners. The first one I got was, will you send a copy out to the presentation at the end? We will post it online, so we'll make sure you know about that. So it will be coming. I do have a question. We're going to do this kind of as a power round. So if you want to answer it, let me know. And then we're going to probably go with one answer unless somebody's burning to disagree, and then we'll move on to the next. So the first question is, what is the advantage to developers in getting funding from an opportunity fund versus funding from a bank or a traditional investor? Anyone want to take that one?
Advantage to developers?
Yes.
Getting funded is the advantage to the developer, generally speaking. They tend not to care where it comes from. If you have a development that is not right straight down the fairway, so it's not 250 units of market rate apartments in a secondary or primary market, you have a mixed use development with some retail. Maybe you have a school there and a little bit of office and then a co-working space and then some housing. Those types of investments are pretty attractive from an opportunity zone investment because I've got 10 years to make that work, but pretty hard to get funded in the traditional place. So I would just think of it more as a funding mechanism of I can maybe be a little bit more creative with my development if I've got an opportunity zone project.
Okay. I have a question here that says, as a buyer broker, how do I find out if a property is eligible for opportunity funds? Who do I contact to apply for the funds? Well, I mean, it would be a deal, so you'd apply in the same way that you'd go after any deal. But if you're interested in knowing whether a parcel or an area or an intersection is in an opportunity zone, I would suggest, at least as a first effort, that you go on our website and look at our opportunity zone map. If you go to azcommerce.com and type in opportunity zones, we've got a whole bunch of resources, and one of those is a map that's just the opportunity zones, so you can zoom in as tight as you want. and get a sense of that. We also have a map called our Arizona Assets Map, and that has not just the opportunity zones, but it has things like, here's the railroads, here's the hospitals, here's the schools, here's whether this is privately owned or federally owned land, et cetera, et cetera.
There's
So
a couple of national opportunity zone fund directories that are out there. I think Novogradac has one. I don't remember the name of the other one, but
there's a coalition of housing, state housing authorities.
And we're listed on a couple of them. And that way, if you're in the brokerage community, just speaking directly to that community now, if you have oftentimes you find yourself in the position where you've got somebody who wants to sell, but they don't want to take the capital gain. So if you can educate them on opportunity zones, they might actually sell, which, is good for the brokerage community to transact. And so going online, looking at those directories, there's probably about 200-300 funds out there right now. And then looking at funds that are probably based or have a focus in your geographic area would probably lead you to the highest level of success. Because like I said, investing at the end of the day in real estate is still very local. And not only can your investor, would that maybe induce your seller to potentially sell, but it also gives them an opportunity if their property happens to be located in an opportunity zone, they could partner with an outside fund. That outside fund could bring in fresh capital and they could gain some of the benefits without having to sell. So there's a lot of different flexibility for that in the brokerage community, and starting at the directory would be a great place.
And I have to throw in another plug for the Arizona Opportunity Zones Network, which has the folks who are sitting around the table here today and who are with us virtually, and that's another opportunity to see who they are and what they're interested in. We've got a number of questions that center on potential changes to the legislation that enables opportunity funds and zones, up to and including, will we get an extension on the 15% basis benefit extended into 2020, all the way to, will the whole thing be repealed?
I have some commentary there. I think Oliver, if he's still around,
but I think Jonathan is also trying to.
Jonathan, please go first.
You want to jump in on that?
Yeah, I don't think we're facing repeal anytime too soon. Certainly, New York Times coverage has been pretty poor recently, but it's kind of hard to put a tax incentive back in the box after it's come out. So I'm not expecting anything quite that drastic. But the two key things that we're looking forward to right now on the legislative front and IRS front are, one, at the end of the year, the IRS will be releasing its final guidelines. It'll contain some fairly useful clarifications on OZ implementation that practitioners and investors alike have been waiting for. I'm on the Federal Policy Working Group and then also the Technical Corrections Working Group, and just in that process, it's clear that an extension from the 2026 deferred tax date to 2027, that's not something that comes out of IRS. If and when it happens, it'll be a legislative fix. So I would look to Congress to provide that solution. In my mind, it's probably better than 85% chance that we do get an extension from 2026 to 2027. But unfortunately, Congress isn't going to act that quickly. I think you're gonna see an amendment maybe sometime in the first quarter of 2020. So anyone who's trying to kind of game the system and say, well, should I invest in December or should I wait till January? Will I get clarity on the extension? By New Year's Eve, I don't think you're going to get the clarity that you're looking for. So, you can either take a leap of faith and wait till 2020 and, hope that you get an extension to 2027, or you can invest now. But given the choice, it's probably going to be safer to put your capital into a fund today.
Did you want to add anything to that, Chris?
Just a couple of other, this is kind of technical stuff, but it really affects the developers out there. One thing I'm really hoping to see, which I think is a significantly high possibility of it happening, is a fix to the problem of basically land syndication, or even if you were adding up businesses. So say that Jonathan wanted to do a private equity deal, but it required him to buy 3 different companies, and the deal works if he can acquire all 3. But if of the 3, if one of the companies doesn't have enough, there's not ability for him to do the substantial improvement investment. But if you add all three up together, he can. Right now, that's a transaction that can't get done in the real estate world. It's very simple, infill development. Most of the census tracts that were identified as opportunity zones in urban areas are in infill locations, meaning there's not large amounts of land sitting around that you can go buy and do large projects on. And most of the time when you're doing a new development or some sort of substantial improvement of an area, you really do need to add up parts and pieces of properties and then bring them together to build something. In the infill location right now, every single one of those parts and pieces has to fulfill this substantial improvement test, which is functionally not how real estate development works. And anytime that there's been a rule or there's been a part of the law or the rulemaking process that seems to be completely contrary to how the actual market works, we've actually seen that they've eventually clarified it in our favor. So I'm hoping that one changes.
So you're hoping that you'll be able to do substantial improvement in the aggregate.
Yeah. If like we have the 10 buildings in downtown Mesa, I don't want to think about whether this building is in this ratio or that. This is the 10 building project. This is the business plan for that project. We bought it for 10 million. We need to put 7 million in improvements in. Whether it goes into that building or this building, who cares?
Okay. We had a question, and I remember this about a year ago. There was a lot of talk about combining opportunity fund benefits with new market tax credits, historical tax credits, low-income housing tax credits, all of these other federal tax programs, which are not explicitly prohibited to be paired with opportunity funds. So there's a lot of excitement and also a lot of terror of how does this actually happen? It just seemed like a lot of billable lawyer and accountant hours would go into figuring that one out. And there was also the question of could you combine it with other incentives at the local level? So we know there's still some of that going on. I'm curious, for the fund sponsors, have you done any deals that take advantage of any of those other local or federal tax programs? Or even if you haven't done them, have you looked at them and walked away? Have you seen other people doing them? What is the sort of appetite and interest in that kind of combination right now?
We've done a GIPLET deal down in Tucson, which is the most viable and obvious thing for real estate development.
Do you want to explain for those who may not know what a GIPLET is?
Yeah, so there's a tax, essentially we're able to recover a portion of the sales tax and maybe potentially the property tax that we create, in building a new building that creates new sales and property taxes. This is on a hotel in particular. And a piece of that is refunded back to us, basically. And by doing that, we have a higher net operating income than we would normally have, which we look at as additional equity and additional return on investment. So that incentivizes us to build the building, especially with construction pricing at all-time highs and raising by 5 to 20%, depending on the piece of material every year. Having some tax relief, and especially on the short term, allows us to basically spend more to build something if we have to. So that's been very helpful. Would love to do a bunch of workforce housing and low-income housing if we could. There's just a mismatch that we need to be able to sell within 10 to 15 years in general. And a lot of those credits, even though we could technically sell, they don't really let you unless you're going to keep it for 20 to 30. I think it doesn't make any sense, because why not just do a bunch of 10 to 15 year projects and then roll them over? That makes a lot of sense to me, but that doesn't seem to fit. So far, we don't really know what to do at this point in time, but we'd love to do a lot of housing because there's a huge need in most of the opportunity zones for housing.
Jonathan, what's your experience with this?
Yeah, new market tax credits and OZ equity capital pair up relatively well. We're doing that in multiple transactions. Arctaris has some of its own new markets tax credits that we're putting into transactions, and then other CDEs, other allocatees of the NMTCs are coming in as well. Doing it the way that we do it, the new market tax credits really become a form of low-cost debt financing that would come in senior to the OZ equity. So new market tax credits are, by regulation, it's a 7-year hold requirement, and opportunity zones are a 10-year requirement. So the debt gets paid off or refinanced at 7 years, and then the equity would exit after the 10th year. The the two maps, New Market Tax Credit census tracts and OZ census tracts, have fairly good overlap as well. When you think about the project equity in a New Market Tax Credit transaction, and just, for definition's sake, if someone talks about a $10 million New Market Tax Credit, there's roughly $3 million of project equity in that transaction that doesn't get paid back at the tail end. It doesn't accrue interest, but that equity can be treated as a junior equity at the end of the day. It could actually be junior credit support in favor of the OZ equity investors, or it could be seen as something senior to the OZ equity. The other kind of pairing of federal and local incentives that we're making use of a fair amount is guarantees. So a lot of states have something like a commercial loan guarantee program, or something, think of it as like an SBA loan guarantee, 90% principal protection for a loan on some particular company or project. If the lender suffers a default loss, the government reimburses a portion of that loss. So we did a transaction like that with Kresge Foundation, $15 million of principal protection. Finance Authority of Maine put in $10 million of principal protection. And this is kind of like, you can think of it as an insurance policy. You hope that you never lose money, but if you do, if you make an OZ equity investment and at the end of 10 years you sell the project for something less than you put in, there is an insurance-like product from a foundation or a state economic development agency that will reimburse a portion of that loss. In Maine, it's 90 cents on the dollar. So these types of programs, which are available at both the state and federal level, U.S. Department of Agriculture has some things kind of like this as well. In these situations, that type of principal protection is highly effective. The third thing, and I'll go quick on this because I know I've talked too long, is EDA grants. We're partnering with nonprofits. Generally, it would be a government agency of some sort, to apply to the Economic Development Administration, federal government, for grants. And if you think of, our project is, say, a manufacturing company with a factory and some sort of industrial park, the grants may pay for the land and the solar farm and water and utilities. Think of it as 20 or 30% of total project cost. And then we would put in the cash above and beyond that to bring in the company and the capital equipment and everything else. So the key with those EDA relationships, though, is that the nonprofit partner, usually the government agency, will need to own whatever was built with that grant. So you own a factory, you own a company, you own a bunch of capital equipment, but the earth beneath you is still owned by a nonprofit. In these types of situations with businesses, that marriage actually works very well. But you do have a 20-year commitment where that land does need to be held by the nonprofit. So I think these things do stack well together. And like I said before, a lot of these projects, it's not like, well, it was a bad deal, it was a challenging deal, nobody could have done it. But for the fact of opportunity zones, it takes one or two or three additional layers in the capital stack to make these things possible.
And Sean, just to add into that, all these federal programs I think are excellent to layer in. In Arizona, really there is only GPLET, government property lease excise tax. That's the game across the state. It's really by statute where you are deeding the property to, in this case, a municipality. You're then paying an excise tax instead of ad valorem taxes. That can be a significant difference. And then if you're in a central business district and a redevelopment area, you're eligible for the tax abatement of that. Basically, that excise tax can be abated for 8 years. That can be huge, okay? But again, these are targeted to low mod, which is what we're in. Use them if they're available. And I know Mesa's taken advantage of them in a couple of opportunities in the past couple of years.
Okay, I want to ask one last question. I want to thank all the panelists because I know this has been a long 2 hours and I appreciate your enthusiastic participation. We're coming up on the end of 2019, which is, as the law is structured right now, kind of the best year for investors to jump in, at least to the funds, if not the funds into investments, but the funds, given that they're encouraged, if not pitchforked by the statute, to invest that money very quickly and commit it very quickly. We should see a lot of interesting things happening at the beginning of 2020, I would imagine. So I want to ask you, what do you expect for the rest of 2019, what we still have left, and into 2020? Chris, do you want to start on that?
Sure. So coming into the end of 2019, we do expect an uptick in investment capital just because, you know, you're sitting around your family at Thanksgiving or whatever, you get a lot of time in the holidays to take a step back from your business, your life, or whatever it is you have going on. And it's like, oh, we do have one of these capital gains. We do need to make a decision now. And that typically happens every year for us in the fourth quarter, where we start to see a lot of investor movement towards the funds. You know, coming into 2020, if you look at the expiration of that 5% component, it's mathematically almost immaterial compared to the entire benefit if executed properly in an opportunity zone. So I would give you the idea that what's more important, that we have a Maybach or a Porsche to drive, we're going down into the Porsche land, or is it more important that we have a road to drive on? And all of the capital infrastructure that I mentioned that's being laid and has been laid and is currently being laid to make it easier for investors to learn about these funds, find them on their wealth management platform, invest, get good advice from their CPAs and their lawyers and other service providers, and feel comfortable with making the investment is far more important than the slight reduction in benefit that will happen between 2019 and 2020. So I expect 2020 to be by far a banner year for raising capital in the opportunity zone funds. I think the only thing that really messes that up is, you know, some sort of disruption with, you know, national politics or whatever that just makes people fearful. When people are fearful, they just don't want to do anything.
Jonathan, what do you see for the rest of 2019 and into 2020?
Well, I thinking kind of optimistically about this, you know, a lot of the first wave of opportunity zone projects that became publicly known were, you know, things that had been in the woodwork since long before the OZ legislation. A lot of the projects that, you know, multiple practitioners have been working on in 2019 will be closing before year end or early in 2020, and I think you're going to start to see significantly more you know, positive press on this market. You know, one other thing that I think we're looking at is with obviously a presidential campaign here, you're going to see a lot more debate on transparency and reporting. You know, Arctaris is one of those firms that said, you know, we will be, you know, counting the jobs we create, we'll be measuring the impact we deliver to communities, and we'll be sharing it with our stakeholders and anyone else who cares to follow that data. You know, at the same time, you know, that's sort of our choice. There are lots of people that, you know, probably don't want their investments or their use of the tax incentive aired out there as dirty laundry. I don't know Mike Milken, but I'm guessing that, you know, when he made whatever that investment was in Las Vegas, he wasn't expecting it was going to wind up on the front page of the New York Times. So I think, you know, there's going to be a very careful debate here to think, okay, you know, is it a good thing to get billionaires to invest in these areas and to give them some sort of confidentiality, or should we keep their money out of places like Las Vegas or opportunity zones throughout the state of Arizona unless they're willing to let it be publicly known? And it's a very difficult, sticky debate, but I think that's going to be a hot button presidential campaign issue. And I haven't seen either party come out with a very conclusive answer on what they actually want yet.
Yeah, it's so simple, so complex, but so simple. So simple because when you look at those types of people with the access that they have to service and other things, if they want to avoid tax, they can in most cases. And where does it go? It goes into a variety of Wall Street oriented vehicles that makes it into some mutual fund somewhere across the world that does zero for Mesa, Arizona.
Yeah,
you know,
true.
And people complain about, these guys are getting a tax break. They were getting a tax break, for the last 100 years. At least you're getting them to invest in our local communities and build, infrastructure in Maine, for God's sakes, versus building, infrastructure in Saudi Arabia through a foreign investment fund. Like this is a huge opportunity for our country. And a lot of people are caught up in the noise and reading these articles in the New York Times and such and thinking, oh, how terrible it is that we're giving these people a tax incentive. Trust me, they already had it.
Yeah, good point.
Yeah, on the incentive side, and I'd just also add, people have been using their money to do bad things for many years too, like, kicking poor family out of their homes to make way for higher paying renters. It's not that opportunity zones suddenly led to unwanted gentrification. It's just, none of us like the fact that a tax incentive is rewarding people that do bad things. So I agree. It's a really complicated issue, but kind of money tends to flow on its own in its own direction, and it's hard to navigate, hard to direct it in the right areas. But I'm glad that a lot of people on this call feel that it's important to do that.
Well, I want to thank you all for being a part of this. I want to thank our attendees for listening in. I've got my slide up here right now. My name is Shawn Neidorf. If you need help, if you have questions, please email me. I'm sorry that we were not able to get to everybody's questions in the 2 hours, but watch our website because we will have this webinar posted. We have lots of other resources, including some guidelines that are really aimed at rural economic developers, but could be helpful for any economic developers. We have the Arizona Opportunity Zones Network. We've got lots of maps. We are happy to help. Go ahead and send me an email and I will happily get back to you. And again, thank you very much for being part of this today. Goodbye.
Thank you.
All right, thank you, Shawn.